Hi, good evening, everybody. Thanks for joining the second live session of Dalalstreet.ai in our Traders Cafe. So, today we have our speaker, Madhu Yerameli, who is a fintech product leader and a subject matter expert in financial empowerment. He is a MBA finance graduate from Hult International Business School in Boston and also a graduate level um, degree holder from Harvard University in finance subjects. He's going to teach us about the basic mathematics principles which we can use in common sense investing, which he have applied in his own portfolios. Hi, Madhu, please.
Hi. Hello, folks. If you do have any questions, I'm not sure how the system here works. Feel free to stop or raise as the system allows. So, welcome. It's a pleasure talking to you and presenting. So, let's start. So, the reason why I'm talking about this is because I used to day trade a long time ago. I don't anymore because I realized it was an obsession and a drug. So I now just follow long-term investments as my principal strategy. What I mean by that is, over the last decade or so, I've put away small amounts of money through this strategy and this approach, and given I do a lot of math for a living, it served me very well. I've had a lot of people. I've spoken to a lot of people. I've also had a lot of success with this strategy. So I thought I'll bring it up here and show you what served me well. And happy to answer the questions that you'd like. So I'm going to quickly share my screen. I know the screens are going to be small for the mobile users. So I've gone ahead and tried to make this as mobile friendly as possible. Do let me know if you have any issues seeing my presentation. I'm going to keep it very light. So we're going to talk about my initial foray into investing. Just quick question to the hosts: are you able to see my presentation as intended? Just double checking once. Charita, Vishnu.
Yes,
Okay,
ma'am.
perfect. So
Thank you.
let's start with my initial foray into investing, my success and failures. So as I said, I first started playing the stock market, day trading in my MBA. Started a small $500 account, which I borrowed from a friend of mine actually. It did very well, and then I realized at some point it became an obsession. So I actually had to stop doing it. And I also picked up a lot of bad behavior. So similarly, I had a few other investments that I really messed up. Long story short, luckily I got into the cryptocurrency space a few years ahead of the curve. Been doing pretty well there. Made a couple of bad mistakes though. Still made a profit, but nowhere close to what I'd like it to be. Uh, Also, I did invest outside the traditional stock market. As you know, I did buy a few pre-IPO stocks from employees for a few companies. Some of it completely vanished. Some of it still exists, but had a number of successes and failures. And what I've consistently noticed was my failures usually come when I lack discipline, when I make impulse decisions, and I make a big mistake. Uh, so that's broadly my initial foray into investing, and then I've just stuck around for a long time since then. Yeah, my portfolio includes your traditional stocks and bonds. It also includes a crypto portfolio. I also have invested in a couple of small startups. So that's broadly my portfolio. Happy to answer questions later if you have any. So I'll continue going ahead. Um, so I like this principle of time and money for investments, and I'll get to that. So the old joke, if you remember, success equals time and money. We all know that, which is also, if you remember, an old math, and is also multiplier. But money can be spent and earned. Time, on the other hand, can only be spent. It's a limited and precious resource. The thing Bitcoin, we keep talking about Bitcoin, right? But that's the same principle time has, right? You only have so many years in your life. So time is far greater than money, and this is something we'll keep discussing over and over again. uh, Lesser your time, the lesser you have time, the more valuable it is. And this is where you see, as you grow older, you tend to earn more, but that's also partly because you tend to live a lot lesser as you grow older. So time is an exponential money. As a consequence, uh, time is always a multiple of money. And I put these two proverbs I really like. I put them back in the behind the deck. I forgot to remove it here. But time is free, but it's priceless, right? You can't own it, you can't use it, you can't keep it. You can spend it though, and once you've lost it, you can never get it back, right? And the next one I really, really love. It is the time you have wasted for your rows that makes your rows so important. Uh, you can replace rows with anything you like, anything you love, right? Any one you love, and you will always see that it actually applies. And this is why time to me is the most valuable asset you have for investing. And these are the two words we'll keep going back to as a consequence. These are the only two principles I followed in investment. One is diversification. Diversification is the most important thing you do. You never bet all your money on one horse. You always spread it out, because bad investments, uh, fingers crossed, get outperformed by good investments. And never assume you'll always make the right choice here. There's a very good chance a good chunk of your investment will go bad. So it's very important to diversify. And the second thing is expected return. I'm just giving you a net zero example, but we will talk about it a little further. Very important, in your mind, you set an expected return. Now, this could be from the market, this could be from your personal desires, this could be your personal aspirations, but put a number, write it down on a piece of paper, and stick to it. And this is what I said. Whenever I didn't stick to it, I made mistakes and I lost money. Yeah. This is just a little chart I put together. So if today I put $10 and I let it grow for 30 years at the three interest rates of 10%, 7.5%, and 5%, in 30 years, that $10 would be worth about $1,660. So 16 times it will grow in 30 years, right? Assuming it grows at a rate of 10%. Every percent you go beyond this, the power of compounding really kicks in. Time is as I said, time is the most important value here. How long you keep your money invested, the more it multiplies. This is a very simple chart, but there are other ways you can add to this. Your monthly systematic investment plans, regularly investing and topping up that baseline number in your money will actually keep serving this exponential curve even further. There's a multiplier effect, because every month if you put money, yes, you lose 1 month of gains on the end goal, but you keep adding and stacking up each time. Yeah. Now, this is one I said annual returns, and this is so the first one actually. So interest in this chart. If you put $10 today in, you actually get 30 years down the line. Each day you get $150. So you actually make more money, 15 times more money than you actually invested today, right? Same thing applies for fund value. You can see this $100 fund blowing up to about $1,600. Small mistake with the chart labeling, but again, this uses the same 10, 7.5, and 5% returns. As I told you, just go back to this old joke, new take on an old joke. Time is free, but it's precious, priceless. And this is actually the example I'm going to give you about the power of diversification. So this is a real portfolio, not a real one. I just put this here, and I actually chose the condoms semi-randomly. In fact, I took a lot of them from the Dalalstreet-ai website when I was just seeing which ones turned up first on my list, except for a couple of them which I personally like. So I made the assumption that I put 1 lakh spread as 10,000 across each of these companies in 2012 to this date, December 3rd. There are several models you can use, and they'll give you a number. So I used, you can reach out to me later if you want to know which model I used. I made a slightly custom model based on what I typically do. I predicted that my 1 lakh investment in 10 years would be worth 4 lakhs. I actually got all the red things I predicted there are numbers I actually over predicted. I got them wrong. And the green ones I predicted lesser than the returns I would actually get, right? If I took a bet and I went only for these 4 or 5 the red companies, I would have actually not made the money I wanted. But when I mixed this portfolio, diversified my risk, yes, for example, I could have simply gone, for example, with you can actually, I don't have the other lines here because I was trying to shrink it to this form factor, so I couldn't put it here. But the one that really, really blew up was Adani Power. They grew by somewhere in the ballpark of, I think, 500% or something over 500% during the prediction. Similarly, another company that really blew up was Birla Soft. These were two companies I could have simply bet on them, made a lot of money. But then if I made a mistake, I would have lost a lot. So it's very important you diversify. It's very important you set a target, work against it, understand you're going to make mistakes. So it's interesting. It's semi-random in my choice. The distribution of right and wrong is almost half, 50. It's 60-40, but if you have a large enough portfolio, you would notice it'll be surprisingly close to 50-50, because at the end of the day, the stock market itself did not quadruple in the last 10 years, it less than doubled. Uh, and that means not everybody can actually grow at that rate. So you're going to lose money somewhere or the other, right? There are other ways you can cut this. You can do fundamentals of a company's annual reports, quarterly returns, and all that, and that'll actually make this number more accurate. But for the sake of this exercise, I've just used daily stock prices and a few other parameters purely from trading data. There is no business fundamentals used here. So when it comes to commerce and investment, the key is to strike a balance between maximizing your expected return and minimizing your risk. On one side, how do you make money? On the other side, how do you not lose money? Very important you have both of these in place. And I'm going to keep my last slide, which is in summary. Invest your time. Make sure you invest your time in your research. There are many ways you can invest your time when you make investments. It's far more valuable than your money. Far more valuable than your money. Yeah. Think and have an expected return in mind. Absolutely important. You set that number. Keep it in. Keep that discipline, right? Diversify by industry, by asset class, and by risk profile. Very important. I personally like 20% of all my investments to be in what I call high risk investments. A lot of them fail. A lot of them explode, and they're very, very successful. I like to spread my asset classes, as I said, between stocks, bonds, crypto, and as well as direct equity holdings in companies which are not publicly traded, right? But the industry diversification is the most interesting thing. So not all industries do well at all times, right? I'll give you an example. During COVID, hospitality tanked, healthcare probably did very well, based on the numbers. So it's important you diversify by industry. It's very important you understand that, global large macroeconomic movements in the world will never uplift all industries at all times. They will hurt some, they will benefit others. So it's very important you look at that, and you make sure you have something that's always performing, that's always, or at most times, some part of your portfolio is always in the green. Yeah, very important you do that. Plan your timelines. Very important. Remember, I said plan your expected returns. Also, very important. Plan your timelines. This has been my failure on more than one occasion. On more than one occasion, for personal reasons, I had to destroy my portfolio to take that money out urgently for personal uses. Yeah, can't still regret those decisions. One of them was the night before Musk, if you remember, decided to promote Bitcoin. It is a fun story, but basically, make sure you plan your timelines and review regularly. Very important. If you look at 5-year, for example, historical 5-year performance, that number keeps changing every 6 months, right? So it's very important you go, you check, you review, look at the numbers, understand if things are changing, plan for the changes. Yeah. Do your research. This is not math. This is just, again, goes back to the first point. Please do your research. Especially if you're making 5-year, 10-year investments, the first question you need to ask yourself is, will this company or will this asset continue to exist in a meaningful way 5-10 years down the line, right? FTX, in the crypto context, recently, the disaster, you've been following all the major crypto exchanges crashing right now. You're following. It doesn't happen to stocks and bonds, luckily, with most companies because they're much better regulated. But do your research. Yeah. And the last point kind of ties back to all the points before. Invest with discipline. Decide what is a good number. Decide what's a healthy profit to make. Decide when to cash out. Decide you will review your information every often. Make sure you diversify. You may see certain things that look less profitable today, but they may be your cash cows in the long run. So That's broadly it. That's the broad summary. I would like to stop there with the presentation. I will actually let you guys ask me questions. So I'm just gonna wait here, and I'm just gonna. So I had someone who's asked. Yeah, sorry, I was presenting. I didn't see your screen because I was looking at my screen share.
It's okay. Anyway, we do have a couple of questions already lined up. So, yeah, the first question is, how can I identify the right industry to invest in?
Ah, okay. I like that question. It's a very very interesting question to ask. Industries I personally like. So there are a few ways you can do it, right? Again, there's lots of market movers, reports. They give you a lot of noise about which industries are booming at the moment, which industries are not booming at the moment. But I do look at long-term trends. I look at industries which have. If there's a word people often use, it's called beta. Right? Beta is basically you take the S&P 500, and that's a specific index. The S&P 500 has a beta of 1. You also have different cuts of the S&P 500 beta in different industries. I like industries which have a beta of lesser than 1 because that usually means that they are stable. The right word is they're less wild. They tend to be not violently move with the market. So industries which are which have a very stable beta, logistics, shipping, healthcare in the long run. Of course, technology. You can always invest in technology. Is a good bet. Um, uh, but yeah, so I like to make my 60% of my portfolio would typically be very low beta, so very stable. I don't like to mess with that. 20% of my portfolio, I go nuts. I experiment on all sorts of insane things. Um, the other 20% of my portfolio, I diversify between, as I said, direct investments into companies or pre-IPO shares from employees or crypto. So crypto plus this kind of what I call alternative investments about 20%. 60% is your good old fashioned mutual funds. I don't have the time, so I just go straight into mutual funds or SIPs or whatever. Um, and 20% I do experimental funding. I play around with all sorts of things. So yeah, that's how I look at industries. Um, and again, you broadly can't go wrong within this, with if you have a 5-year horizon or a 10-year horizon because there's a very old strategy. You can look it up. It's called the dartboard strategy. So if you take the New York, there's an actual study done. So if you take a dart and you put all the securities in NYSE, for example, the popular ones, blindfolded, start firing your darts at the board. I think you have to do at least 100. So it's important you do at least 100. You will still do just as fine as every other good investor in the market. It's actually well studied. It's a well studied phenomenon. It's called I believe it's called the dartboard strategy. So uh, diversification automatically will help you. And always, it's also good to have, as I said, countering industries. So you've got travel happening. If travel does well, I believe there's another industry that does badly. So you have to look for inverse relationships. If everybody's healthy, which is then your healthcare industry is going to not do as well, right? And travel is going to go up. So there is some. If I remember, I forgot. I believe travel and healthcare are inversely correlated. So one succeeds, the other doesn't do well, and vice versa. So that's a good way to also look at it.
Okay. And we do have another question. How was your initial 90 days of your journey in trading?
It was a drug, dude. I started with 500. My portfolio grew to $3,000. But I was failing in my exams. I wasn't studying. I was not a good place. I was doing penny stocks. Not a good place. If you want to do day trading, I really all the best. But you need to have a non-addictive personality. Right? You should be the kind of guy who doesn't get hooked to smoking or any of that stuff. Because if you have a tendency to get addicted, I don't recommend day trading. At least not from a financial perspective, but at least from a general mental sanity perspective, I found it to be like a drug. Um, I didn't like it. Um, I made money, but it did affect me in a negative sense.
So the more you made money, the more you got pulled in. That's what you're saying.
The more I made money, the more I got pulled in. The more I made money, the more risks I took. The more I made money, the less I slept. The more the every time you fail in one of those things, it bothers you. You then do other stupid things, and it was cascading. It was a series of cascading issues, and it was not much money. Right? It was $500. Right? I was studying as a student, $500. Grew to about $3,800.
So that
Just
was
because,
everything. That was a good high.
yeah, but it was not good. It was a high. That's the problem. It was a high.
Yes. Okay, we have another question.
Hmm?
Do you believe in strategy of buy and forget?
Yes, definitely. The 60% of my portfolio is buy and forget.
The steady ones, the beta less than one ones.
Yes,
Okay.
60% of my portfolio is buy and forget. Not buy and forget. Buy and reevaluate once a year, maybe.
So long term.
That
That's nice.
60% I'm not like it just exists. And it's doing very well. So I don't like so what I keep doing is every year, not few years, every year I keep adding another small MF
Mm-hmm.
uh, to my portfolio, another one. So it's now about 14 or 15 different funds I'm invested in. So it's a bit of a buy and forget strategy, dude. To be very honest, long ago, so long ago, I still have that fund, some Reliance Tax Saver fund. I think I put 50,000 rupees in, I don't know when. I tried to take that money out because I had to leave the country, but it was not a full 3 years at that point. So they said I can't take the money out. So this is before like proper online management. I had a guy who manages an Excel and all that. He passed away. Forgot that I had a fund. Just forgot that it existed because life and I was traveling and I had a kid and whatever happens, right? So about a year ago, I found the fund. It was there somewhere, it's just existing somewhere, and it's done really well, dude. It's worth like some 4 or 5 times what it was, and I'm like super happy. So it served me well, and it's good. So it's funny because 550,000 became 2 lakhs
Wow. So forgetting is a boon here.
in this scenario. So I wouldn't say that's your principal strategy, right? If you have other things to do and a life and a job to live, you don't want to obsess over this stuff. It's not worth it.
Yes. And
Especially when you're a parent and you have other things to do. Not worth it. Like, at least at my age, it's no longer about me trying to make money. Right? Now it's more like protecting my kind of. It's almost insurance in its own way, right? And that 20% is kind of what I play around with, and that's money I can afford to lose.
okay. So we have another question.
Hmm?
What is your view on global economy? This is positive market reaction after Powell's speech recently.
Trying to think. I haven't actually seen his speech recently. As I said, I don't follow the market on a daily basis yet. I'm more interested in. I'm more again. I haven't followed the market recently for a variety of reasons. As I said, most of my assets are invest and forget. Probably look at it once every few months. But uh, as a whole, I think the global economy, without going into the context of our speech or the recent um, developments,
We
um,
can move on to the next question since you have not followed the speech.
yes, much
Okay.
better. Thanks.
Yes. So we have another question who is from. So you have spoken about the beta less than one stocks, right? So
Yeah,
can you give us some examples of those stocks?
beta less than oh, oops. It's actually beta of a good question. So beta one is S&P 500. So maybe it's not less than one. Good question. I can't remember. But beta is one is the kind of target you want, right?
Okay.
Yeah, beta one, which is kind of your target that you want. Is there a beta less than one? I can't remember.
Okay.
Most of your blue chips would be around. It'll hover around the one range, right? But I can't remember. I haven't seen. And I haven't checked it in a while. Yeah, but no, there should be. Most of them are around the one range. I don't remember off the top of my head if there's a beta less than one. Apologies if I made a mistake. Yeah, sorry about that.
Okay, no problem. So we have one more question. So you said the 20% of your portfolio is where you play around, where you
Mhm.
can afford to lose. But even though you can afford to lose, what kind of exit strategy you play around?
Good question. Let me use an example of an actual exit that happened recently.
Okay.
That's Okay. I'll give you the example. So if you guys remember, one of the interesting bets I'd taken was Adani Power. You can actually see that they between 2016 to now they blew up quite a bit. 2017, 2018 to now they kind of really blew up. Um, so in that scenario, I had set an exit goal of 400%. No matter what, when I hit 400%, I got out. The reason I did that is because when I was doing some day trading, actually I said I don't do day trading, but I was doing it in 2019 to 2020 with cryptocurrency. So there was this day, and I'll never forget it. I had a very large amount of Ethereum. At that time, it was going at 115, $116 briefly in the early 2020s. You can check it out, Jan 15th ish. Um, I had told myself, I set myself an exit goal of a certain number and a very specific set of exit parameters. But there was another crypto on the site called Zcash, which was making some noise. There was some FUD going on that, and I exited my Ethereum position and moved to Zcash. Uh, Ethereum went from 150 to 4,000. Zcash went from 60 to 90. So deeply regret that decision. I still made a profit. I made 50%. And then, in fact, then was even more fun. I forgot about it because I had some personal issues at that point. One night I went in front of the computer, $95 it was. I just put a sell trigger at $100, went to sleep. Next morning I wake up, it's going at 210 bucks. Now, in some ways, and so one more great regret. So, no discipline. So, exit strategy has to be discipline. Ultimately, an exit strategy is what you decide as an exit. You don't make it on the spur of the moment. So in the case of Ether, my exit strategy rightfully should have been hit the damn number, wait until it hits the number, you took a position, you took a bet. If you really wanted to bet on Zcash, put your money on the side. Don't exit your position. Right? So similarly, Zcash, don't be like, don't have a few beers and say, like, hey, I'm just gonna exit my position because it's not made me money. You took a position, you said you're gonna wait until it hits this number. You rushed out of it. So yeah, that's always how I would consider a valid exit strategy. It is very simple. Set a goal, set an objective, or set a timeline. It's always returns or time, all right, and set your exit position there.
Okay. And you stick by it no matter what.
Stick by it, no matter what.
Like,
Same thing for stop loss. So you stick to a stop loss. Every time you wait for that ticker, like I've done this before, right? It's slowly coming to a certain target number. Oh, let me go change that number. You change that number a little 1%, half a percent more, 1%, and you've done it. We've all done that.
we have all done it, yes.
And when you've done it, have you noticed it'll bomb badly behind you?
Definitely it'll bite in the ass.
That's the one thing I have learned never to do. No, I still do it. I'm still guilty of it even today, but I've done it so many times. It's not funny. So I try to avoid doing that.
Okay. Oh, we do have only 1 minute left, but I'm gonna read the last question out, and I'm gonna leave it because the last question is how to understand to buy crypto for diversification. And I'm pretty sure that question is not a 1 minute answer. It's gonna take a whole session.
I'll give
And
you a simple 1 minute brief, and I will not do the detailed session. Very simple. If you're going to invest in crypto, please invest money you're willing to lose.
wow.
Um, do not invest your life savings. I personally know Singapore, as you're aware, is a very active crypto market. I personally know someone who's having to sell their house because of the FTX collapse. So if you're going to invest money in crypto, please have it as side money, not your bread and butter. Not today. The market's not there today. Not because of the underlying crypto itself. The technology is extremely robust. Blockchain. I work in the blockchain. Incredible tech, but it's because of I'm going to excuse my French, but it's because of the assholes who run these companies. Yeah. It's part of bad regulation. It's bad governance. A lot of issues that are going on right now in this market. Uh, so if you're going to invest money in crypto, make money, be happy. Lose money, don't. You're the
Try
only.
your
You just blame yourself for it, right? As I said, blockchain, cryptocurrency. I believe in the technology. I completely believe in it. I invest an incredible amount of my life in it. I didn't want to talk about this topic only because lots of controversy right now in the market, and I'm not very comfortable making any recommendations after FTX because personally I've seen people lose a lot of money
okay.
uh, because of the FTX thing. Money vanished. Money is just gone. Right. That's not an investment. That's really the underlying infrastructure failing. Right.
Okay. Thank you so much, Madhu. So we are done with all the Q&A. So we have had a great session. We have learned a lot, and it's also fun. We would like to get you back as talking about cryptos again, maybe. So thank you so much, and thanks everyone who have joined and asked questions. Hope all your questions have been answered.
Thank you. A pleasure all.
Thank you.